don't put any thought into it will say that it's a Ponzi.
If this was actually a Ponzi, then what you would hear would be there is no risk. What the reality is that it's really hard to break it. I agree that people should own Bitcoin directly. I also think that you have to provide solutions to legitimate problems. Digital credit is a true solution.
We're already seeing it with STRC. There's these DeFi tokens, and they're buying hundreds of millions of dollars worth of STRC to offer DeFi protocols on top of this whole entire thing. What is the risk in that?
People will build great things on top of it, and they're going to build bad things on top of it. Do I think that over time some of those things could blow up? I think it's possible there's going to be very, very concentrated wealth because of AI, because of the monetary failure of fiat currencies. Bitcoin and amplified Bitcoin is the way to take advantage of this in a deep way.
Let's address some of the criticisms, right? Because you'll see them online, and some of them I think are ridiculous, and some actually I have some questions myself. So the first one, you'll see it for the lowest hanging fruit is it's a Ponzi, right? And it's the people who don't put any thought into it will say that. What is the 1, 2, 3 sentence line you can give somebody to dismiss the fact that it's a Ponzi?
Yeah, it's structured finance. And so if you believe that mortgage-backed securities, that the banking industry, everything is a Ponzi, then you could also say that digital credit's a Ponzi, and then your view of the world would be that you should only buy one thing. You should only buy a direct bearer asset. You should only buy Bitcoin itself. You should only buy gold. You should buy nothing else. The entire economy is a Ponzi. Well, that's not a legal argument that Strive or anyone else is doing anything illegal. It's just a criticism on the entire world, right? And so do I think that idea has merit, not that in the sense of a Ponzi, but in the sense that bearer assets should be owned by individuals? I agree with that. I agree that people should own Bitcoin directly. I also think that you have to meet people where they are, and you have to provide solutions to legitimate problems. And I think digital credit is a true solution, and it strips down some of the return and some of the volatility of Bitcoin. And then it pushes that other excess potential return and volatility into the common equity. That is just math. We have never stated that SATA or Stretch is risk-free. In fact, we talk in depth about kind of what you have to assume with Bitcoin for it to make sense over the long run, and we've talked about kind of a break-even return right now for SATA of around 6% Bitcoin growth over the long run, with Strive implementing things like our cash holdings as an example to be able to mitigate short-term volatility in Bitcoin prices. But you do need to underwrite that Bitcoin will not fail for SATA to do well. And I think that if this was actually a Ponzi, then what you would hear would be there is no risk. There is no way this thing can't do well. And we've always said, part of the reason, and what's funny is that people will push back about us calling digital credit because they'll say, well, it's not a bond, it's equity. And the point is that the risk is in the credit. That is the only risk that we see. It's underwriting the credit. And so it is digital credit. That is the sole risk. It's underwriting Bitcoin, but you don't have to underwrite it to the degree that you have to on the common, right? It's a much lower return hurdle. But I think we're pretty transparent about what that risk is. And then we're also very transparent about going into scenarios about what has to be true for this to go well. And what the reality is that it's really hard. It's not impossible, but it's really hard to break it.
And so let's look at the opposite scenario where SATA just explodes. It's gangbusters. It's so popular, and your obligations grow very quickly, say faster than the growth of Bitcoin. Is that a scenario that's possible, and how do you address it?
So there's a couple different release valves here. So we obviously, SATA is a variable rate product, so we can move the interest rate up, move the interest rate down. My base case scenario is I would like to keep the interest rate around here because I want to grow SATA so big, because I don't view that as a problem. I view that as a thing I want to make happen, right? But in the scenario that the demand was more than we could possibly handle, then you would start to see the interest rate of SATA be brought down on a month-by-month basis. And it can be brought down by 25 basis points plus the change in SOFR. And so you could bring that interest rate down pretty quickly. You can also issue common equity shares into the market, right, to control that amplification. What's interesting is that, the balance sheet growing. So if we're issuing SATA shares, we're buying Bitcoin, right? Which means the balance sheet expands massively, which is sometimes in the math something that people don't fully, they look at the static state and they're just like, oh, if your amplification expands, well, you have, 16,000 Bitcoin. We have substantially more Bitcoin in that scenario, right? And so our ability to control it is, I think, maybe a little bit better than people think. We've also modeled Monte Carlo simulations and feel comfortable with amplification going substantially higher than it is right now from a credit risk and our ability to meet our obligations. I would say that, to be intellectually fair, that part of our job is to keep people's confidence both in SATA and ASST as a whole high. And I don't mean any individual, right? Like there's always going to be individuals that are going to think that either or both of them are too risky, right? But like the market's perception as a whole high. And so what I think you're seeing is that the market actually is, from a ASST perspective and the market perspective, rewarding amplification. They're rewarding high amplification. Our MNAV is higher than strategy. Other players that have less amplification have typically lower MNAVs, right? That the market wants a levered Bitcoin exposure on the common. So generally speaking, more amplification has been rewarded, not punished. And then on the SATA side, if there's runaway demand, then that can only mean that the SATA investors feel comfortable with SATA if they're continuing to push demand in, right? So if that remains true, then I think the scenario of it breaking is pretty low. In the scenario that happened, though, there are release valve mechanisms like we talked about that we could take.
And then lastly, you have talked about an ecosystem being built on top of these products, correct? And we're already seeing it with STRC. There's these DeFi tokens, and they're buying hundreds of millions of dollars worth of STRC to offer DeFi protocols on top of this whole entire thing. What is the risk in that, right? We've seen before, of course, that leverage has caused problems within the Bitcoin ecosystem, and as well as the fact that now there's been more DeFi hacks and exploits in the last 3 months than there ever has been in history almost. So talk about these tokens being built on top of SATA.
Mm-hmm. So, obviously with DeFi, there is contract risk that could pop up, and that would be for investors in DeFi protocols, obviously, to underwrite. But with both Bitcoin and with digital credit, we can't control what's built on top of digital credit. Bitcoin can't control. A lot of Bitcoiners wish that digital credit didn't exist, but you can't control it, right? And you can't control if some government buys Bitcoin, right? We have no ability to control who buys digital credit. And so my expectation is that take any great product, and Bitcoin being the ultimate great product, people will build great things on top of it, and they're going to build bad things on top of it. And sometimes you may not know initially if it's going to be a great thing or it's going to be a bad thing. And even the idea itself could be a great idea, and some people will do it well, some people will do it poorly. Like some people run a Bitcoin treasury company well, some people run a Bitcoin treasury company poorly. I think some people will innovate on top of digital credit well, some people will do it poorly. Within the DeFi ecosystem, I do think there is an obvious place of demand for why there's a desire to do this. And what that demand is actually the same reason that there's a lot of demand for stablecoins. The people that the biggest investor in stablecoins are people overseas that want to take their money out of their authoritarian country or whatever and be parked something outside the system, but don't want the volatility of Bitcoin. Like that is the demand source for stablecoins, and it's hundreds of billions of dollars, right? And so if you can, within the DeFi protocol system, create a version of digital credit that takes a US listed security and puts it in a wrapper that makes it available to these people that are stablecoin buyers, there's, in my view, obviously going to be a ton of demand for those digital credit instruments, right? And so that will happen on the DeFi protocols. That in and of itself doesn't need some crazy forms of leverage, right, to succeed. It just needs to be able to be put in a way that is accessible to those individuals, kind of through an intermediary that underwrites and takes that risks and how they package it, because Strive cannot, we can't offer this to those people, right? But can someone build on top of it without our permission? Like they can do, we can't stop them, right? Like they can do whatever they want to do. So that to me is a place that, should succeed. Do I think that there will be people that will put like leverage on top of the yield profile to kind of do something crazy? Yes, I do. Do I think that over time that some of those things could, blow up if to the extent that it's done? Yeah, I think it's possible. But what's interesting is that those types of things don't create structural risk to us as an issuer. What they could do in a stress scenario would be to on a short-term basis to put a little bit of price volatility into the instrument, but my expectation would be that there would be a lot of buyers. We as an issuer could do several types of actions like we could to support the price of SATA. Strategy could do the same for Stretch. So I don't think it represents a structural issue, but I do think that it represents what are the risks of potential price volatility in these instruments? I would say that would be a risk of short or potentially in the worst maybe medium term price volatility, but not credit volatility for us as an issuer.
Okay, so let's end our conversation looking into the future. You came into Bitcoin because you realized how bad the debt situation is for America. And you've said it before in this conversation, you think we're in a fourth turning, and you also have children that I'm sure you hope to see grow and thrive in America in the decades ahead. Do you think that products like SATA and this new Bitcoin banking ecosystem are going to provide a bridge to a new economic paradigm that we will see in the future, or does it have to be a rocky road to get there?
I think they will be a bridge to those that take it. I think that just as a hardcore Bitcoiner, the more that you're invested directly in Bitcoin, or my belief, amplified Bitcoin exposure for those that are doing it well, like Strive and Strategy and a few others, will be the way to, I think, make riches in this transition. So I think I think digital credit is like the smooth path to, make yourself a little bit better off during this transition. Bitcoin and amplified Bitcoin is the way to like really monetize this and take advantage of this in a deep way, but it's a rocky road. And then for those that don't buy, any form of Bitcoin or digital credit, and they just kind of keep doing what they're doing, I think they will likely suffer from less wealth in this monetary transition. But I don't think that they'll, go without type sort of thing. I think they'll be fine, but I think it's just, one of these things where it will become more and more difficult for those people that ignore every form of Bitcoin or Bitcoin type risk to afford to buy a house and those types of things. And I think they'll be more likely to be part of the kind of permanent rentership society, which, and I think with AI probably involves like, this isn't necessarily like what I want. It's more of what I think will happen, but some form of like UBI in the future, because there's going to be very, very concentrated wealth because of AI, because of, the monetary failure of fiat currencies. But I think that digital credit is a bridge for people that, want a bridge, but also are not completely convicted to ride out the volatility of Bitcoin.
Yeah, and whether it's inflation or the job market, all these things are just a screaming advertisement for Bitcoin, right? And so that case just gets louder and louder.
Thanks for making it to the end of the video. If you could drop a like and a share, it would help in our mission to accelerate adoption. If you're looking for more Bitcoin signal, join over 10,000 readers of our newsletter, Bitcoin News Weekly. Every Monday morning, we send out the biggest headlines of Bitcoin to keep you in the know in under 5 minutes. Links below in the description. Then come hang with us live every Monday at 11 a.m. Eastern. We break it all down live on stream with a new guest, and you can add your 2 sats in the chat. See you next week.